what they mean. Where did they come out with all of these claims? Bright, thank you very much for joining us.
Thank you very much, Samson. Right. Can you hear me clearly?
Very, very clearly.
Wonderful. And I think with your permission, can I just make a presentation to explain what we mean by gold for oil, etc., because that will help a lot of your viewers understand when we start to explain the losses and the origin of the losses.
Exactly my invitation to you, sir.
Thank you so very much. We're always grateful for these opportunities. So what we're going to be doing now is describing in some detail, within a short amount of time that we have, how the Gold for Oil program was conceived, how it was supposed to be executed, how it eventually was executed, and how through that execution we had already predicted, materialized, and eventually led to losses that we believe amount to losses to the state, which requires additional investigation and possible prosecution of those found guilty. That's criminally guilty, if any. So first of all, let's start off with consumption of fuel in this country. Fuel, like other commodities, have to be refined to be used. So there's crude oil, which is oil that you take raw from the ground. Then you refine it into different kinds of fuel used for different purposes. There are fuel that you use in your car, typically called gasoline, or in Ghana we tend to call it petrol. There is diesel, which is very similar. There is aviation fuel, which is used for planes, marine fuel used for ships and boats and things like that, etc., etc. Kerosene, all of these are fuels. On the screen, you see that our consumption of fuel has been increasing quite dramatically. I'm only showing you for gasoline. And you can see that the amount of gasoline we consume has more than quadrupled over this very short period from 2000s until now. But there are other types of fuels, and this what you see on the screen now is a breakdown of some of the different kinds of fuels that we use. And what has happened over the years is because of weak industrial policy or problems in our industrial policy, we are not able to refine these fuels in our own country. We have to import them. Or at the very least, we have to import the vast majority of the fuels that we consume, the tonnage of the fuels we consume. And the amount of money, the dollars that we were using, moved between $250 million to about $400 million because as consumption grew, the more money we needed to import. What is funny though is that as consumption grew, the economies of scale should have improved, making it more viable to produce refined fuel in our country. Because the more you consume, the bigger the output is, and therefore often the more efficient your refinery plants will be. Even though we have two major refining plants in the country, the oil refinery and Central, both of them are not functioning to their fullest and their optimal due to weak policy. And this is what I call cartonomics, where we often are very clear what we want and we define it often in political terms. So we want to improve our ability to add value to our commodities. So we produce oil, we want to add value to it. This is something that every political actor in this country supports. This is something that everybody in this country kind of wants to happen. We want to reduce how much of our dollars that we use to import goods from outside, etc. However, when it comes to the how we actually do these things, somehow we disconnect the stated objective from the actual mechanics of getting the result. So we have this so-called economic problem that continues to be dealt as a country. So in short, we've not been able to fix the oil refinery and Central, and therefore we keep importing fuel. Over the 2021-2022 period, as most of us know, the economic situation got pretty bad, and there was pressure on the currency, there was pressure on prices, so inflation was building up. The government wanted innovative ways to try and navigate those issues. And one of the suggestions was that because we have gold in our country, we could buy gold in cities and then somehow use the gold to acquire oil, in which case we bypass the need for dollars. Because other than that, then you need dollars, about $400 million a month, to bring in the refined fuel. Why don't you simply take the gold that you have in your country, buy it in cities, and then exchange it for oil, in which case you don't need the dollars. So the pressure on the currency, which builds up through the demand for dollars, will moderate. So that was the logic that was presented. The truth is, if you see the chart on the screen, I don't intend to go into any technical economics, but the general idea is for this to work, you need some kind of arbitrage. If gold is valuable, and gold is what we have, is valuable, and gold can be sold for dollars, but somehow you want to use gold to get oil, then reason you would do that, translating gold directly to oil is more beneficial than changing gold to dollars and then using dollars to buy oil. That would be the only logical reason why you will use a barter model or exchange your gold for oil. Because somehow the way that they are priced in the two different markets, the gold market in which you operate in your domestic market, and the oil market that applies where you want to get the oil, there is some dynamic between the two that allows you to exchange your gold for oil at a better rate than it would be if you went first selling your gold for dollars and then using the dollars to buy oil. So that would be the justification, the rationale for using a barter model instead of going to the market like everybody goes to the market. So the barter model will only make sense if somehow you've been able to establish that the exchange rate between gold that you get in your country and oil that you get in a specific market is more favorable than what you will get if you converted your gold to dollars and then use dollars to buy. This is just a quick explanation of basic commodity market, just so that when I refer to some of the issues, you understand what it means. Typically, you have what we call the spot market, which is what you the market where you buy immediately and you are settled immediately. So I have money, I want to buy oil. I pay for the price as it prevails. Then I hand over the money in the settlement and I collect my oil. So that will be a spot market. There are also what we call the futures market, where you are buying, even though you are making commitments today, the oil that you are buying is not to be delivered today, it's delivered in the future. And therefore, there's a forecast future price. And then you have a commodity supply, you have a commodity demander, somebody who wants the commodity, etc. And then in between, you have people that often try to arbitrage between the spot market and the futures market. This is just a rough, quick, simple explanation because I'll refer to that again later on. Another thing you also have to know about the transactions that often if you're doing a commodity transaction, if you're changing oil to gold to oil, things like that, you will often need brokers. You are doing a swap. Now, those brokers may be on the buy side or the sell side. It can get really complicated. We don't want to go into all of that. But bear in mind that sometimes if you want gold, somebody has oil, you have gold, and you want to bridge a trade, it's not all the time that there's an alignment in terms of who needs what when. So there are people that will often intermediate because they have storage capacity, they have distribution capacity, etc., who can play a role in making the match happen. And that's the difference between money and commodities, right? Because in money, I can just take your money even when I don't need the money immediately, and I can use it whenever I want. With commodities, let's say you have an oil refinery and I have gold. When you need the gold and when I need the oil, the timing may not match. There could be timing mismatch, so many other mismatches. So often, a whole bunch of intermediaries develop to try and smooth the markets and create parity of need. And this is why it becomes interesting. So going back to the point again, for gold, for oil to make sense, you need to start to have another exchange rate separate from monetary exchange rates. And this will be the exchange rate between two commodities that you are interested in, gold and oil. So you build an exchange rate between gold and oil, and then you're able to compare it with the other alternative exchange rate, which is the gold in cedis, which implies a cedi to dollars, because if you sell your gold to get dollars, you have a particular exchange rate you're using. And then the other exchange rate, which will be oil to dollars, right? So you have two different exchange rates in play. So what you are trying to do with gold for oil is you're trying to bypass those two other exchange rates. You don't want to care about how much oil is sold in dollars and how much gold is sold in dollars. You want to immediately connect gold to oil, and you are bypassing all those two other exchange rates because you think somehow you can get it at a more favorable rate if you did the direct transaction. So now that I've taken the challenge is what I've tried to explain is that often because the timing there's a mismatch in the timing, etc., you end up having multiple actors involved because you have one broker in between another broker, etc. Sometimes it's also a matter of volume. Let's say the person that you are trying to exchange your gold for oil with, they have a certain quantity of gold they need for a particular period, and they then have to aggregate on their side so that they can get more demand to match the amount of oil that you want supplied, etc. So these can lead to complicated multilateral arrangements as well. In short, you are often in a barter arrangement looking at the pros and cons, whether or not you are conserving capital versus whether or not you are getting the right amount of value, whether or not you have a relationship that allow you to get something at a better price than the open market, or if because of tax exemptions and things like that, it's much better to do an exchange than to do a direct trade. So there are two key issues we have to bear in mind. One of them is that there are transparent markets in oil, in gold, and in those transparent markets, typically we are dealing with cash. I want to sell my gold. I go to a transparent market like the London Bullion Market, LBMA, or Shanghai COMEX, any of these international markets. And there's so many buyers and sellers. So we have what we call price discovery. The prices are very well known, very well transparent, and they are often highly liquid markets. If you want oil, they are there's the same situation. You go to oil markets. Rotterdam is a major oil market for refined oil. Antwerp, there are refined commodity markets also in Chicago, etc.
I'm Gabrielle. I go by Gabby. I'm from Nigeria. I heard about LCHE from a friend.
As much refined fuel as you want. And based on that dynamic, there are indices like Platts, Argus, and the rest, which transparently broadcast the price to everybody. But if you decide that those two kind of dynamics, those two markets don't suit you, the oil market as is transparently known, the gold market is transparently known, because for some reason you can trade directly, then you come into a situation where, as we are going to try and prove now, you have to show that the results that you got was better than what you would have got if you did in the open market. In the case of gold for oil, eventually what we learned is that there was actually no butter. That's the most critical discovery. And getting dollars. So it wasn't as if there was a refinery that had refined fuel to sell to us that wanted gold for some other reason, and we're brokering that gold deal. It turns out that what happened is we were selling the gold to some intermediaries, getting dollars, and using those dollars to buy refined fuel on behalf of BOST. So there were traders who would sell oil to refined fuel to BOST, like gasoline and diesel and the rest, and they were receiving the dollars. So ultimately, the effect of the whole arrangement was that BOST became a major player in importing of fuels and displaced some of the private importers. Ultimately, I think it got about 30% of the market, that's approximately, down from what it used to enjoy before gold for oil came in. So the effect of gold for oil primarily was to increase BOST's market share. Remember though that if we wanted to do that, we could simply have just provided dollars to BOST on a loan basis and got BOST to import oil. I mean, if that's what we really wanted. So it's not as if we wanted to support BOST and make BOST a more effective player, we need to do gold for oil. I'm just explaining that one of the effects of gold for oil was that BOST, which was a state-owned distributor, acquired greater market share. Okay. Now, here is the problem. You've got gold, which you are buying in cedis, and you want to get oil, which is sold in dollars, right? You end up still doing what you're doing anyway. The difference here, though, is that we don't really know who you are trading the gold with to get the dollars and who you are brokering with in order for the oil in its refined form to be delivered to BOST. So you had all these brokers that emerge, and I've listed some of them: Alpha Stream, StoneX, Abu Dhabi Catalyst Partners, that in the beginning were relatively well understood because we did investigations and we discovered who some of these players were. But even so, these were not disclosed publicly. Not publicly disclosed who these intermediaries were. But then things got worse. As the process unfolded, it became impossible for us to get leaks anymore to know who they were actually dealing with. So on the side of the aggregation, who was the Bank of Ghana using to buy the gold in cedis? What was the forex rate that they were applying? Because remember that gold has an international market. So even if I'm selling to you in Ghana, I have my mind that I can sell it internationally, and therefore there's a certain rate that I'm trying to use. And then what was the actual price that they were paying? None of this information was ever publicly disclosed. So they would do a deal in Ghana, they would buy the gold from aggregators and then sometimes they would finance the aggregators. So that's where these gold rich issues come in. They will give money in advance to the aggregator to go and buy the gold and bring it to them in cities. And then when they get the gold, they have to send it to somebody else through another series of intermediaries to get the realized dollar. And then when they get the dollars, they then have to use the dollars to buy the fuel and bring it in. In each of these instances, there were no public disclosures of who these actors were, who was aggregating the gold on the ground, who was eventually bearing the risk of any losses that arise if you buy the good at a certain price and the price moves in the international market in a way that you can't realize the dollar value. All those challenges arise from lack of transparency, is the opacity. That's what delivered those problems. So there are theoretical risks that we knew, which we warned about. And those theoretical risks include the fact that if you give money to someone to go and buy gold for you, the person may bring you less gold than you anticipated. The gold that the person brought to you, the gold content, because what you get is what we call DOR, which is a kind of gold that is refined to a certain point. The gold that is sold in the international market is often refined to 99.9%, etc. What you get from buying in the market in Ghana may be 90% or even less, or 92% or whatever. So due to all those dynamics, the prices may change and may shift. All of those dynamics require transparency. Now, if you miss, it's a loss. So this myth issue we are talking about is a similar problem, where money was given to some party to go and get gold on behalf of meth, and over time it was realized that somehow, because of all these, instabilities in the way that the regime was set up, you accumulate loss over time, which ordinarily you shouldn't, because these are very mature markets. How did we get our loss numbers that we've put out? It's a very simple matter. We know the realized losses. The Bank of Ghana has already told us about the foreign exchange losses. And those foreign exchange losses arise simply because you buy the CD you buy the gold in CDs at a certain rate, you are exporting the gold and you are realizing dollar in a certain rate, etc. And you eventually, those rates may move against you and you get a realized forex loss. There are also issues around the intertemporal, what we call the intertemporal. The gold prices are moving in a certain direction and you have the opportunity to accumulate reserves over time. So if you don't accumulate resource and instead you commit to certain prices, and therefore, because you want to buy oil through this very murky process and the rest, you're not able to accumulate the reserves as a bank. So you don't benefit from the increase in prices in the gold price that you would have got if you were accumulating your reserves. There are also issues around the hedging and the basis risk that we've investigated. There are issues around import premia, etc. If you get involved in oil trading, there are so many of these different core elements where if you do a counterfactual analysis, that's if the Bank of Ghana had not done that, what would have been the realized gain or loss? So we have just done a counterfactual analysis. And from 2.14 billion established by the Bank of Ghana itself, we've looked at all the other situations in which the Bank of Ghana could have avoided losses or made gains, and which it didn't. And so based on that accumulation, we've come to this 7.2 billion number. Remember that number is an analytical number, because nobody really knows today what the full losses are. The engaged, reputable and auditing companies to go through everything and come up with a final number. So what Imani is doing is providing you with a model that gives you a sense of how much loss could have been accumulated based on counterfactual analysis, if you had done this other than that. And you can also use the same to query consumer welfare. So if, for instance, we had that gold for oil, could that have led to, for instance, higher prices at the pump, or could that have led to a pressure on our currency, etc.? And the argument we've made is that neither case is true, because number one, we know for sure that they were not directly converting the gold for oil, right? They still went to get dollars anyway. And so they could simply have sold the gold, acquired the dollars, given it to the commercial banks or the BDCs through their auction process, as they already do as a central bank, because these BDCs were already supplying 70% anyway, even during gold for oil. So given all those facts, they will have done all of those issues, and then the pricing dynamics in the market will not have changed. In fact, if you apply our counterfactual analysis and you look at, okay, how much dollar would have gone into the market if the BOG had been more transparent in the way that it did this and passed the dollars through an auction process, the effect is that actually we may have had slightly lower oil prices during gold for slightly lower fuel prices during the gold for oil phase than we eventually did. So in effect, neither of the benefits were materialized. And the reason the benefit didn't materialize is very simple. The gold market and the oil market are highly mature markets. There's very little creativity you can apply as a small country in Africa to somehow try and game that market.
Okay.
If you want to sell your gold, sell your gold. If you want to go and buy oil, go and buy my oil. Buy them in transparent markets where you have multiple buyers and multiple sellers, and you get the best price discovery. So that basically is the analysis that the money has done. And I hope this was clear.
Right. It was useful, but help me do this quickly. You say there was absolutely nothing innovative about the Gold for Oil program. This country needs about $4 billion every year for refined fuel imports. We had gold. There's been good price for gold. It is soaring. We are told even today that it's likely to end at about 4,000 per ounce, or is it ton in the per ounce by December.
Per troy ounce.
Yes. So there's nothing innovative about it. What do you think was the rationale? Why did we do it?
What was told to us is not what was done. You see, if somehow the government have found a set of market conditions that allows to exchange gold directly for oil in a way that was more favorable than selling the gold for dollars and then buying the oil, then that would have been innovative, because that would be some kind of innovative instrument, maybe some kind of synthetic financial instrument with multiple hedge points, optionals, etc., etc. There are a lot of financial engineering that goes on in the world. And then maybe you find certain people that for some reason, they don't want to use the international gold market. They want to buy the gold directly for
Let me ask this question again. What is your suspicion? Because if by doing this, we have fuel prices at a rate which could have been lower, according to your analysis, what is your suspicion why this was done?
My point is that the eventual beneficiaries of this scheme were the brokers and the middlemen. The only person who got any benefit are the people that were in the middle, doing the monetization, that were in the middle, enabling the shipment of the fuel to bust, etc. They are the ones who benefited. Nobody else benefited. Ghana could simply have said, okay, we have our domestic gold purchasing program. We are buying gold in cities. We sold the gold on the international markets at the current price. That money is in our reserves. We've auctioned dollars to BDCs who import the fuel. Because of that auction, there's more availability of dollars. That would have all been entirely transparent, and within the current policy set. Why did they need to embed middlemen that they didn't disclose at multiple levels of this program, when eventually, as we've now found out, they were still selling the gold for dollars and buying oil in dollars? What then was the point? So the only benefit to anyone is the brokers and the intermediaries, Alpha Stream and the others we don't know, and people like Goldridge or companies like Goldridge that have made a lot of money purporting to intermediate two markets that are supremely mature, and we don't need any intermediaries. So it was done to enrich the intermediaries, is what I'm saying.
Right. Someone will ask what is new about that kind of model of business in Ghana. Because even if the Ministry of Agric was looking to buy toothpick, it won't go buy it itself. It will find a middleman, so the middleman will benefit, and you will find later that this middleman is connected to some political something, and they're going to make money to fund some party. So this is not new. So what's strange about it?
The beautiful thing about your analogy is that imagine that we said we don't produce enough fertilizers in Ghana because our industrial policy has failed. So the likes of Bluefet and the rest are not producing enough fertilizer. We need to import fertilizer, right? And then the Ministry of Agriculture said, you know what? The way we are going to do it is that we are going to do rice fertilizer, right? We will get some people to go and buy rice in Ghana, and then we will go to Egypt or somewhere else, and we will exchange the rice for fertilizer. What would be the first thing that comes to your mind if they made such a proposal? Your first question you ask yourself is, why don't simply sell the rice, get the money and buy the fertilizer? Unless they can prove to you that somehow they have an effective means, because somehow there is someone that will, for some reason, rather than buy rice on the international market at same price, we like Ghana rice for some reason. Maybe there's something peculiar about Ghana rice. So if this was the only channel they will get a Ghana rice, then they will give you fertilizer at a rate that was better than if you try to buy fertilizer on the international market. So you give them the rice and you get fertilizer at a better rate overall.
Right.
In this case, we went in a different way, right? We went in the same way that I've just described, but it didn't make sense in the sense that we sold the gold for dollars, but at a rates that are not transparent, through brokers that are unknown, except those of us that do investigation. And then eventually we got the dollars and then went through the same route to get the fuel and bring it to Ghana, benefiting multiple middlemen and brokers in the chain. And our argument is that the only reason anyone wanted to do this was because they wanted a channel through which they could benefit and enrich some intermediaries.
Right.
And our argument is the country's resources cannot be put at the disposal of such schemes.
Right.
We cannot have a country where politicians.
That's understood. That's understood. My last but one question to you before I bring in Kojopoku is this one. That's, you know, right. We live in a crazy country, don't we? We go and cut down trees that have survived for decades in order to plant new trees. And when we plant the new trees, we don't take care of them and then they die. So the old ones that were surviving, we have cut them down. You remember? Yeah. You remember this project?
I remember it very well.
Thank you very much. This is what we do in this country.
So investigation,
exactly. Yeah. Now my question is, these 7.2 billion Ghana cedis, its potential loss, you are not saying it is lost.
Yes, I think I made that very clear that the losses that we are describing are realized losses that have been confirmed by the Bank of Ghana, plus counterfactual losses. So it's an analytical point. It establishes the losses that we know for sure, and then it says that based on the way they did it, if they have done it in another fashion which is more transparent, and therefore the Bank of Ghana have built its reserves, you know, the auction market had worked as it normally works, etc., the ultimate outcome will have led to certain gains and certain avoided losses. And if you add all of that together, there's a potential that you could have made 7.2 billion cedi loss. Of course, we are waiting for that's why we did what we did. We are waiting for the audits that are going on the civil side, which is basically the Bank of Ghana audits and stuff like that. And also we are urging that forensic audits current, you know, be instituted. And we know the OSP is not doing forensic losses, for instance, he's doing criminal prosecutions and investigations. So that's a different matter. But we're asking also for forensic audits. Every single intermediary, we know some of them because we've done investigations, but we are not authorities. They are authorities. They should investigate every single player in that particular scheme, every single trade in that particular scheme, and then look at the implied foreign exchange rate, etc. Because our analysis of the implied foreign exchange rate, our analysis of the implied premium, all of that has led us to this conclusion of losses.
Right.
But we are not a state auditing agency.
Right. And I need a very quick...
Somebody else has to do the work.
I need some 30 seconds on this. You speak about tax exemptions. Did you find that these tax exemptions were granted by Parliament in the first place?
Well, the tax exemptions element of it, I don't want to delve into it too much because there are some additional work that is ongoing in that respect. Just as I also don't want to delve into the specific criminal liability attached to specific individuals and the rest because of the petition.
Okay.